Even we look at what happened yesterday between bunds and BTPs. You saw bunds spike by 60, bunds spike by 20, and the BTPs dropped by 60 basis points. Again, you know, there's a bit more volatility when it comes to a BTP and a political twist. So give me your take at the moment. What's my BTP risk? Because ultimately I'm backstopped by the ECB, aren't I? Ultimately, there's a bandwidth here beyond which we will not break.
Quite right. And the game-changing event of last year was the recovery fund and the next-gen issuance that's going to come from the EU, and also the PEP. So the fact that the ECB is there, as you just mentioned. So that changes the picture somewhat compared to previous crises. I mean, you could go back and look at 2011, 2012, and you'll see Italian bond yields were up to 7%. That's 700 basis points. So the game has completely changed. But it's a timely reminder of how these markets are all intermingled. Because when we look at treasuries and bunds, they're often driven by actions elsewhere. And now, if Italy is the current flashpoint, it can create flights into quality, as we call it. So that's why the bond market has been rallying, and I dare say it will support treasuries as well. It depends just how serious this is, because I think the market's grown accustomed to these political comings and goings in Italy and other countries. So, look, it's another thing for us to absorb in markets, and it's a reason why I'm keen to stress that when we look at the bond yield forecasts, it's quite an integrated process. It's not a simple case of just looking at the local fundamentals. Everything is interlinked.
Let's just close off with some of your big sort of stage-setting calls for 2021. With that coalescing of risks around the world and risks in the US, is that what makes you still stick to 0.75%? In other words, we're anchored at that level in US Treasuries, or what's your other main piece call for 2021?
Well, that forecast has become the big call. The 10-year rate is a reference rate for everyone else in all kinds of markets, equities and FX, EM. It's the big call, and it's become the big call because the market has moved. Because we've had a repricing of treasuries, our forecast now looks very bullish. So in a way, I'm pleased that we've had this correction in markets, because we've got something now to say. The forecast is the forecast, and the forecast doesn't move with the spot rate. It's based on where we think the equilibrium rate should be. And also, we're looking through the noise of the inflation that's coming through this month and next towards year end. And I think that you'll find that inflation is below 2% at year end. Rates are going nowhere, and the Fed is signaling that they're on hold for many years. That's more consistent with a valuation for treasuries with yields below 1%. And that's why our forecast is 75.
Stephen, very quickly, markets often, as you and I both know, overreach, over-arc, and get over-aggressive. Where's the risk point of the equity, the EM trade, in the nominal bond yield in the United States of America? What's the trigger point for an unwinding of this, perhaps exuberance?
Yeah, that's a good point, because again, in the forecasting process, we've got to think about what's happening to risky assets. So real yields have done nothing, and the main movement is in inflation expectations in the last few weeks and months. So equities are priced off of this extraordinarily low real yield long into the future. And I wonder what happens if that ever gets disrupted, because you could quite easily get a situation where nominal yields are contained by the Fed and the market. Inflation was to peak in a month or so and then start dropping off. You'll find real yields going up. I mean, you cannot make these stories up, Manas, but it's quite possible, because the real yield, to me, is a residual that drops out of an equation anyway. So risky assets seem to be priced off of the lower for longer, and it's very easy for some kind of disruption to come through.